If you own a North Carolina business and die tomorrow, three things go wrong all at once. Your business freezes in probate, your family gets a tax bill that nobody told them to expect, and all of your key employees start updating their resumes. No single advisor is watching all three. That's what this video fixes. In business succession planning, there always ends up being this three-party collision. The estate planner thinks that the trust controls things, the CPA thinks that the entity structure takes care of it, and the financial advisor thinks that the life insurance will make everything okay. Each is doing their job, but nobody is watching the intersection of those 3 points. And that's where North Carolina business owner families lose the most. You need a team that's coordinated. Cary Estate Planning is the answer. Click the link below to begin. In forming North Carolina entities like LLCs for ongoing businesses, we often create what's called an operating agreement. And the operating agreement is something separate and apart from the estate plan. And the estate plan and the operating agreement almost never intersect. Operating agreements that are created when the business was first opened often just embedded a bunch of default language that really didn't contemplate you even having an estate plan, let alone injecting itself into the estate plan that you may already have. Most of the time, there's some default buy-sell provisions that require your other members to buy out your interest from your estate, making sure that that transaction is coordinated with your executor or administrator if you don't have a will at all. At some point later, you may have created an estate plan that has nothing to do with your operating agreement or the membership interest that you hold. Your estate plan has a trust that isn't even listed or even known within your operating agreement. Those two documents contradict each other, but when you pass away, the operating agreement is what's going to control, not your estate plan. In North Carolina, most business owners that own a business that could potentially survive them want to include very intentional buy-sell provisions either as a separate agreement or within their operating agreement. There's usually three types of buy-sell provisions that a North Carolina business owner might want to include in their buy-sell agreement. The first is a cross-purchase obligation, meaning you're not the only owner. There are partners involved, one or more. And if one of you passes away, the others have to buy out your interest for themselves. They personally, as partners, will buy your interest to increase their interest in the business. Those cross-purchase obligations are usually either an installment note paid over time, sometimes 5 or 10 years after you pass away, or funded with a life insurance policy that's specifically meant to pay at your death and provide liquidity for this purchase to be effectuated. The second is an entity purchase where life insurance is paid to the LLC itself and the LLC redeems the interest from the deceased member, basically taking it back and making it so that the remaining interests are 100% of what's available. And then the third option is a hybrid of those two things, often referred to as a wait and see approach, meaning the entity is given a right of first option and could renounce or resign that option in favor of the remaining partners triggering it instead. Each of these options have different tax consequences and should be used or chosen very deliberately given your goals and your circumstances. A very common way to fund a buy-sell provision when there are multiple partners that own the business together is for them to acquire life insurance on the other. But life insurance funding is not some one-size-fits-all proposition. The first issue that can arise with life insurance funding is how much should the value of life insurance be worth? And often that's just set at whatever we think the business would be worth when we formed it. And so as most successful businesses do, the value of the business may grow over time, leaving a funding shortfall that the life insurance may not be able to bridge. The second issue with life insurance is ownership. Who is the policy owner when it comes to this life insurance? It could be the other partners in the business acquiring an insurance policy on the life of their partner. It could be the LLC itself acquiring the interest and holding the policy on each or any of the members' lives. You've worked hard for everything that you have. Click the link below and start protecting it today. Now, in each of these options, the membership interest is owned by an individual directly. So a person owns the company interest. It's called a membership interest. In North Carolina, LLC membership interests are considered probate assets. They're personal property of the individual who owns them. So if an individual member passes away, owning the interest in their own name, that share of the company often has to go through probate, which can be problematic for business operations. A common solution for North Carolina business owners is to create a revocable trust that holds their membership interest instead of owning it individually. This is going to accomplish really two main objectives. First is it's going to keep that ownership interest outside of probate, outside of court control, and solve for any incapacity issues of the individual owner. During your lifetime, we transfer that membership interest into your trust, and your death creates this reality where we're changing control of the trust rather than changing ownership of the LLC interest. The second is that these buy-sell provisions are being coordinated with your trustee of your trust rather than being paid to or funded through probate, which can be much less costly, much less involved, and a much shorter timeline of process and things that otherwise we'd want to avoid. If life insurance isn't a complete solution, then the trust can serve as the intermediary or the receiver of the installment payments or proceeds of this sale. Could be because you're uninsurable and can't get life insurance to cover the buy-sell itself. Could be because the life insurance value wasn't enough to cover the full value of the estate or the membership interest being purchased. Either way, the trust provides something that's easier to transact with and can continue to receive installment note payments over 5 or 10 years without having to go through probate. Ultimately, there isn't a one-size-fits-all solution for this reality. It depends on your partnership structure, the ability to be insured, the terms that you can agree to, and of course, valuation of the business. But there's 3 things that you should do this quarter. First is pull your operating agreement and see what the provisions of it actually say. Does your operating agreement contemplate a smooth transition for things like a trust or to avoid probate? The second is get an up-to-date valuation of your business. What is it actually worth today versus what it was worth when you formed it? And the third is to get the estate planner, the tax specialist, and the financial advisor all on a call to coordinate today. Not next week, not next year, not next decade, but today. The North Carolina Business Owner Playbook isn't about picking one strategy. It's about making sure that the strategies are talking together. If your business is worth $2 million or more and you haven't had this coordination call, that's where the work is. Link below. The next video dives into the buy-sell agreement itself, the agreement that most North Carolina business owners get wrong. Probate, taxes, and creditors are preventable. Schedule your consultation with Cary Estate Planning now.